Ladies and gentlemen, if you think you know what's happening with silver, think again because what's about to hit this market this week will shock you. Not rumor, not hype, not maybe. I'm talking about real historic market moving phenomena, the kind that separates smart capital from fools, the kind that changes wealth and careers overnight. You see, I've been in commodities longer than most of you have been alive. I've watched bubbles bust panics, and this week, silver is showing the signs of every one of them. Prices have been on a roller coaster, record highs punctuated by explosive volatility. That just doesn't make sense unless you understand the larger forces at work. People keep asking why silver is moving like this, why it's jumping one day and collapsing the next, why it feels unstable, uncomfortable, even frightening. And that tells me most people still don't understand what kind of market they're dealing with. When a market starts behaving this way, violent rallies, sudden drops, no respect for logic on the surface. It's not random, a signal. Markets don't scream without a reason. They whisper first, then they shake, and only at the end do they explode. I've seen this movie before. I've seen it in oil. I've seen it in currencies. I've seen it in agriculture. Extreme volatility is not a bug. It's a feature of a market that's being repriced. Silver is not just going up or going down. It's being argued over hard by very powerful forces with very different agendas. And when that happens, price becomes erratic, emotional, almost irrational to those who don't see the full picture. Look at the moves we've already witnessed. Silver surged to levels most people thought were impossible, and then just as quickly it was smashed down. That's not normal trading. That's not retail investors clicking buy and sell on their phones. That's big money repositioning, hedging, panicking, defending, and sometimes forcing the market where they need it to go, at least temporarily. When you see a market make historic highs and then experience sharp, sudden corrections, you are looking at stress, structural stress, and stress only appears when something underneath is changing. Most people think volatility means danger. Experienced investors know volatility means information. It tells you that expectations are shifting faster than the models can adjust. Silver has been ignored for years, even decades, dismissed as the little brother of gold. But suddenly, it's demanding attention and markets hate being forced to reevaluate assumptions overnight. Here's the part very few want to admit them. When a market is this thin leveraged and this emotionally charged small events create huge reactions. Policy comment, a future duration, a liquidity squeeze, surprise data print, things that would barely move other markets can send silver flying or crashing in hours. That's why these swings feel unbelievable, because they're exposing how fragile the structure really is. People also forget history. Silver has always been one of the most volatile assets on Earth. When it moves, it doesn't tiptoe, it runs. In past cycles, silver didn't climb smoothly. It lurched. It scared people out before, rewarding those who understood what they owned. This metal has a habit of humiliating the impatient and re-rewarding the prepared. And right now we're seeing classic signs of a market that is no longer comfortable at old price levels. Every attempt to push it down needs aggressive buying. Every breakout invites violent resistance. That tug of war creates the chaos you're watching on the screen. But chaos isn't permanent. It resolves always. What makes this moment especially interesting is timing. Volatility at the beginning of a move looks very different from volatility at the end. At the end, everyone is euphoric. At the beginning, everyone is confused. They don't know whether to believe the move or fade it. They don't trust it. They argue about it. That's exactly where silver is right now. This is not a sleepy market drifting higher. This is a market waking up angrily, and then waking markets knock people out of bed. They force repositioning. They force mistakes. They expose whose over-lever actually understands risk. So when you see silver swinging wildly this week, don't ask why it's unstable. Ask why it's suddenly so important. Markets only behave this way when the old story is breaking and a new one hasn't fully formed yet. And those moments, rare, uncomfortable, misunderstood, are where the biggest opportunities are born. Not when everyone agrees, not when volatility disappears, but when nobody feels safe in price, refuses to behave. That's when you should pay attention. People spend far too much time watching prices and far too little time watching power. Markets don't move just because numbers change on a screen. They move because decisions are made behind closed doors by central banks, by governments, by institutions, trying to survive the consequences of their own mistakes. And silver right now is sitting directly in the crossfire of those decisions. When policymakers lose control, Hard assets start behaving differently. They stop responding politely. They start reacting violently. And that's exactly what you're seeing. Rates, debt levels, political pressure. None of this exists in isolation. Every time a central bank hesitates, pivots, sends mixed signals, it sends shock waves through currency markets. And when confidence in paper weakens even slightly, metals feel first. What most people don't realize is that silver is more sensitive to these macro shifts than almost any other asset. It's not just a monetary metal. It's not just an industrial metal. It lives in both worlds. And that makes it incredibly reactive. When inflation fears rise, silver reacts when growth fears rise. Silver reacts when liquidity tightens. Silver reacts sometimes in the opposite direction. People expect that confuses them. But confusion is normal when a market reflects competing narratives at the same time. Right now, policymakers are trapped. They talk tough about inflation while quietly worrying about debt. They promise stability while adjusting rules as they go. That kind of environment creates uncertainty, not the theoretical kind, but the real kind the capital can feel. Money hates uncertainty. It either hides or it hedges. Silver is one of those hedges, and that's why every major policy signal seems to hit this market like a hammer. Also have to understand timing. Markets don't wait for official announcements. They front run them. They sniff out stress before it becomes public. When you see silver reacting sharply to what looks like nothing, it's usually reacting to something most people haven't connected yet. The subtle shift in language and behind-the-scenes disagreement, political risk that hasn't made the headlines. This metal has a long memory, and it's brutally honest. Another thing people underestimate is how political markets have become. Central banks are no longer independent in the way textbooks describe. They are under pressure from voters, from governments. That pressure leaks into policy, and policy leaks into price. Silver doesn't care about speeches, it cares about consequences. And right now, consequences are piling up faster than solution. When rates are high, people expect metals to struggle. When rates are expected to fall, people expect metals to rally. But reality is never that clean. What matters? Credibility. If markets believe policymakers are in control, metals behave. If markets sense panic and metals don't wait for permission, the violent moves you're seeing suggests that confidence is not as solid as it appears on the surface. This week is important because it sits at the intersection of expectation and reality. Investors are trying to guess what comes next: easing, tightening, intervention, or denial. And silver is reacting to all of it in real time. That's why it feels unpredictable. It's not one bet being placed. Millions of conflicting bets colliding. History tells us something else too. When governments change the rules frequently, capital looks for things that don't depend rules at all. Silver doesn't vote, it doesn't promise, it doesn't issue press releases, it just exists. And in periods when trusts are at us, even quietly, that simplicity becomes powerful. Most people will only understand this after the move is over. They'll say it was obvious. They'll point to one announcement or one event and pretend that was the cause. But those who've watched markets for decades in Nora, big moves are never caused by one thing, caused by pressure building invisibly until price can no longer contain it. So when silver reacts sharply to central bank talk, political noise to global uncertainty, don't dismiss it as overreaction. It's a thermometer, and the temperature right now is rising even if the room's still calm. Markets sense stress long before people do, and silver is sensing a lot of it. Most people still think silver is just a speculative trade, something you buy when you're nervous and sell when the chart looks scary. It's a mistake, a big one. Because while people argue about price, something far more important is happening underneath the surface. And markets always move on fundamental eventually, no matter how long they pretend not to. Silver is not sitting in a vault waiting for investors to feel optimistic. It's being consumed relentlessly. Every year, more of it disappears into factories, technology, infrastructure, and energy systems that modern economies now depend on. Once it's used, much of it is gone forever. You don't recycle it easily, you don't replace it cheaply, and you certainly don't turn production on and off like a faucet. That's the part most people don't understand. Supply is slow, painfully slow. It takes years to discover new deposits, longer to permit them, and even longer to bring them into production. And silver is rarely mined alone. It's often a byproduct of other metals, which means its supply depends on decisions made for entirely different markets. If copper or zinc slows down, silver doesn't care. It slows down too. At the same time, demand doesn't ask permission. Solar panels don't wait for price corrections. Electric vehicles don't pause production because traders feel uncertain. Data centers don't shut down because a futures contract expired. Industrial demand is structural. It's locked in once it accelerates. It doesn't reverse easily. What makes this moment especially interesting is that we're no longer talking about theoretical future demand. It's here. Uh, Governments are committing to electrification. Corporations are racing to automate and digitize. Energy systems are being rebuilt. All of that requires silver, not as an investment choice, but as a necessity. You can substitute opinions. You can't substitute physics. For years, the market ignored this imbalance because above ground inventories existed. Stockpiles mask the problem. They always do. But inventories are not infinite. They get drawn down quietly year after year until suddenly they matter. And when they matter, price has to adjust, not gradually, but aggressively. People also forget that miners don't benefit from low prices. When prices stay suppressed for too long, exploration dries up, projects get shelved, capital goes elsewhere. The result is a future shortage that no amount of short-term price control can fix. You can manipulate sentiment for a while. You can't manipulate geology. That's why silver's behavior feels different now. It's not just responding to fear or speculation. It's responding to reality colliding with complacency. Every sharp move higher is a reminder that the market may have underpriced scarcity. Every violent pullback is an attempt to deny it. This tension creates volatility. But volatility doesn't eliminate shortages. It exposes them. Another uncomfortable truth is that industrial users don't care about investor narratives. If they need silver, they buy it. Prices rise, they complain, and then they pay because stopping production costs more than higher input prices. That puts a floor under demand that most traders underestimate. And when investment demand enters the picture, at the same time when people start noticing what industry already knows, that's when markets retreat quickly, not smoothly, not politely, quickly. History is full of examples like this. Commodities stay cheap longer than expected, then become expensive faster than anyone believes possible. The reason is simple. Supply cannot respond at the speed of financial markets. By the time price sends a signal, it's already too late to fix the problem. Silver is approaching that phase, not because of hype, not because of predictions, but because consumption is colliding with limited supply in a world that wants more technology, more energy, and more infrastructure all at once. Most people will look back and say the signs were obvious. They'll point to charts, headlines, or policy decisions. But the real story is quieter. It's factories ordering more metal. It's miners struggling to replace reserves. Its inventory is shrinking while demand grows steadily. That's not drama, that's math. And math doesn't negotiate. So when you see silver behaving like it's under pressure, don't assume. It's speculation alone. Pressure comes from somewhere, and in this case, it's coming from a world that needs more silver than it can easily produce and is only beginning to realize it. But by the time everyone agrees, the opportunity is usually gone. The market always figures it out eventually. The question is, figures it out first. People love certainty. They crave forecasts that sound confident, targets that feel safe, narratives that remove doubt. That's why most people struggle in moments like this. What's unfolding in silver right now doesn't offer comfort. It offers a choice: risk or opportunity, preparation or panic, understanding or reaction. Silver is one of those markets that doesn't reward casual participation. It never has. It's too small, too emotional, too easily misunderstood. When things are quiet, people ignore it. Things get wild, they cease it. Both approaches usually end the same way badly. The real opportunity lies in understanding why the market behaves this way in the first place. Right now, silver is presenting a rare combination: enormous upside potential paired with very real danger that makes people nervous. They want guarantees, but markets don't give guarantees. They give probabilities. And the probability here is that silver will continue to surprise, frustrate, and shock those who treat it like a simple trade instead of a complex global asset. What makes this moment especially tricky is leverage. This market is full of it. Paper claims far exceed physical reality. That works fine when confidence is high and everyone agrees on direction. It stops working when sentiment flips. Then leverage becomes an accelerant. Moves become exaggerated, losses become sudden, and weak hands get removed quickly. That's not manipulation in the dramatic sense people like to imagine. It's structure. And structure matters. When too many people are positioned the same way, the market's job is to punish them. Silver is very good to that. At the same time, the upside cannot be ignored. This is not a mature bull market with excess everywhere. This is a market that spent years being dismissed, underappreciated,